Did you buy a home in the last 15 years? In Omaha? In the United States? You probably paid 75% more than necessary. It wasn't caused by greedy sellers or even local supply issues, but by a Frankenstein private/government central bank that Americans are forced to deal with when they buy a home, the Federal Reserve. Today we're going to break this down economically, no emotion, no partisan spin, just numbers. And we're going to focus specifically on Omaha, Nebraska. Welcome to Milton's Ghost. Let's establish the baseline. Around 2010, after the housing crash, Omaha's median home price was roughly $160,000. By 2025, roughly $280,000. That's a 75% increase over 15 years. Omaha didn't behave like Phoenix. It didn't double. It didn't implode. It rose steadily, then surged during 2022. The question is, how much of that 75% increase was normal economic growth, and how much was interest rate distortion? Most buyers don't shop based on price. They shop based on monthly payment. How much house can we afford? Let's use a clean example. Assume a buyer can afford $2,000 per month. At a 6% mortgage rate, that buyer can borrow about $333,000. At 4.5%, that jumps to roughly $395,000. At 3%, which we saw in 2020 and 2021, that same buyer can borrow $474,000. That's a 42% increase in purchasing power without earning $1 more. Nothing changed about wages. Nothing changed about the house. Only the cost of money changed. And that cost is heavily influenced by the Federal Reserve. Now let's look at Omaha specifically. From roughly 2019 to 2022, home prices rose about 26%. Now here's where it gets interesting. If dropping mortgage rates from 6% to 3% increases purchasing power by 42%, markets don't capture all of that into price, but they capture a lot. Even if we assume just 60% of that purchasing power flows into price increases, 42%, 60%, wires 25%, that lines up almost perfectly with Omaha's 26% pandemic surge. That strongly suggests most of Omaha's 2020-2022 spike was rate-driven. Now let's decompose the entire 2010 to 2025 increase. Total growth was 75%. It breaks down like this. Interest rate compression, 25 to 30%. Normal inflation and income growth, 20 to 25%. Underbuilding and supply constraints, 15 to 20%. Demographics and migration, 5 to 10%. So, roughly 1/3 to maybe 40% of Omaha's total housing price increase can be attributed to artificially low interest rates. That doesn't mean the Fed caused everything. Remember what we learned in the last video. But it does mean cheap money had a measurable mechanical impact. If rates had stayed at 5 to 6% the entire time, Omaha's median price today might be closer to $210,000 to $225,000 rather than today's mid-range of $325,000. Principal values would be materially lower even as monthly payments stayed the same. An often overlooked element of this is that interest rate manipulation created such high demand that available inventory was wiped out. Inventory in Omaha fell sharply because buyers suddenly had 30 years 40% more purchasing power. Homes sold faster. Bidding wars increased. Realtors measure their inventory in months of sellable property. This metric collapsed. This wasn't because homes disappeared. It was because demand exploded. Now here's the structural distortion. Millions of homeowners locked in 3% mortgages. When rates rose back to 6 to 7%, selling meant giving up a 3% mortgage, buying at double the interest rate, so they didn't sell. Inventory stayed low. And if you remember, low supply means prices tend to go up. Affordability fell. This is called the rate lock-in effect. It's one of the clearest unintended consequences of aggressive monetary policy. In 2026, Omaha's housing inventory has improved, but it still isn't a balanced market. Prices on homes have stagnated, and it is taking a little longer to sell them. Interest rate compression. 25 to 30%. Normal inflation and income growth, 20 to 25%. Underbuilding and supply constraints, 15 to 20%. Demographics and migration, 5 to 10%. So, roughly 1/3 to maybe 40% of Omaha's total housing price increase can be attributed to artificially low interest rates. That doesn't mean the Fed caused everything. Remember what we learned in the last video, but it does mean cheap money had a measurable mechanical impact. If rates had stayed at 5 to 6% the entire time, Omaha's median price today might be closer to $210,000 to $225,000 rather than today's mid-range of $325,000. Principal values would be materially lower even as monthly payments stayed the same. Now here's the twist. Rates returned to 6 to 7% in 2023-2025. So why didn't Omaha prices collapse? Because homeowners are locked into 3% mortgages. They don't want to sell. Inventory stays tight. So instead of a crash, we got stagnation. The distortion created a floor. So, did the Federal Reserve cause Omaha's housing surge? Partially, yes. Not entirely, but measurably. When you artificially lower the cost of money, you raise the price of assets. Housing is simply the most visible example. And Omaha, even stable, steady Omaha, was not immune. If this video made you think and reconsider any previous notions, send it to a friend. And please like and subscribe.